Now, 2023 was a huge year for the US tech giants, and the Magnificent Seven, you know all about that. They led that growth. So why put your money into small and medium global companies at this time? We're going to ask a man who calls himself a contrarian value investor. He is lead portfolio manager at SKAGEN Focus. Please welcome Jonas Edholm.
So, thank you for the attention. And, well, we currently think we have a unique dislocation in global equity markets. And in this presentation, we're going to shed some light on that particular investment opportunity. And we will also talk a little bit about SKAGEN Focus, which the fund I've been running since 2015 with my team, which is a highly contrarian, value-based, price-driven global equity fund with focus on small and mid-cap stocks. We think that's relevant because we think it's uniquely positioned to benefit from these market anomalies we're observing right now over the next 2 to 3 years. And I stumbled upon a quote, and that's a quote from Sir Arthur Conan Doyle, the author of Sherlock Holmes. He once said, "There's nothing more deceptive than the obvious fact." And that is an interesting quote and actually quite relevant for these markets as we look upon them today. There's clearly a need for deeper examination, critical thinking, if you want to operate in these global financial markets over the next 2 to 3 years. So, ladies and gentlemen, that was the noise. You know the conference name, Finding the Alpha Beyond the Noise? That was the noise. Of course, it's easy to follow your impulse and just onboard or take the first obvious train that comes into the platform, isn't it? However, at SKAGEN, our job is to find perhaps the less obvious train, which might provide you with a more interesting journey in terms of results and performance over the next 2 to 3 years. But also interestingly and importantly, a more safer journey. And why is that? Well, we have built up massive concentration risks in global passive equity investor strategies over the last 5 to 6 years, over the last 10 years, which has yet to unravel. So this is an interesting point to consider other avenues of these equity markets. Also, it's easy to ignore warning signs like this. Mind the gap. You've all seen it, right, in your local subway platform. Even at Baker Street, where Sherlock Holmes resides, of course. This is, of course, not only visible in your UK local platform, but also elsewhere on the globe, in other versions. So this indeed seems to be a global phenomena. So let's take a look at this gap, shall we? So what you're seeing here is essentially two charts. You have the white chart is the MSCI large cap index, the price earnings ratio since 2004. And we're thinking large caps about $10 billion US. That's the hurdle for being a large cap in this analysis. Then we have the green line, which is the small and mid cap index over the same period, the price earnings ratio. And there is at least one interesting observation you can derive from this chart. And that is historically, has global small and mid caps been more expensive than large caps? That has been the pattern over history. Now this has changed. We'll see that the discount, it might not look so impressive on this chart, but I'm going to show you a few other charts that make this a little bit more visible. But it's interesting, these small caps, they are actually considered and are actually, by fact, earning higher economic returns over time. They are more agile, they're more focused, they're better equipped to deal with changing operating environments. So this premium has been pretty much established over the years, but this is now reversed. So that's an interesting observation at this point in time, we think. It makes it perhaps a little bit more clearer for you if we look at the relative PE ratio of these two indices. We just take them divided by each other. then you'll see the more extreme point where we're at currently. And this may be a unique discount in global small and mid-cap stocks versus large and mega-cap stocks we've ever seen throughout financial history. We don't have the data in these indices back beyond '04, but this is clearly an extreme level. And you'll see that, of course, we also plotted the recessionary periods here. We had the 2008, 2009 period, the global financial crisis, where small caps, of course, underperformed there for a while. Also in the pandemic, the very brief recession, you had a similar pattern. And now in green, we have the anticipated recession, which of course has yet to come. It may come, we don't know. But the interesting thing is that these global small and mid-cap stocks, especially the cyclical and the value-related stocks, has already priced in a recession behind the corner. That's an interesting risk-reward observation, we think. And you can also see the interesting re-rating potential in these small and mid-cap stocks historically when cyclical pressure have eased. And we may very well be at that turning point as we speak, heading into '24. You can also take a look at the price-book ratio. That's another way of looking at this gap. This discount between these two asset complexes, if you will, start to expand already in 2015. And that was, of course, coinciding with the emergence of these big tech monopolies in the US, where this started to really take shape. And now we're sitting at a record discount here as well in terms of price-book ratios. And we can take this analysis actually even one step further. We can look at a small subset of US equities, namely the 7 largest stocks in the US, that is Apple, Meta Platform, Nvidia, Tesla, Microsoft, Google, etc. They're known as the Magnificent Seven. If we plot their price-earnings ratio during the same period, there's an interesting observation. They're very high, but they have actually derated since 2021. Maybe that's start of a trend. These companies are pretty highly valued and have built amazingly high market caps during this period. And of course, the gap to small and mid-caps is vast. But if you're willing to introduce another data point, if you see in the lower right corner, that's the small cap value space, the small cap value index, trading at around 9 to 10 times forward earnings, which is almost a record low despite last year's rise. So this gap is interesting. So maybe we should stop talking about the Magnificent Seven. Maybe we should talk about the Magnificent Gap in '24 and onwards. So another way, just describing this very weird state we're in global equity markets currently, is by looking at simple market caps. We can see you have the Magnificent Seven combined here in the chart, as you can see, and it dwarfs the UK and the Japanese equity market combined. It even dwarfs the European stock market, which includes giants like Novo Nordisk or LVMH and so on. That's clearly, this is only 7 companies. And also the 6,000 listed small cap stocks globally doesn't even come close to these market caps in the US, in these 7 only companies. So this is clearly, and this is something you get a lot of course, when you're investing into passive equity investments. So how has this dislocation presented itself? What is the background to this? Well, we didn't invent the penguin analogy. I actually saw it firsthand myself when I worked in the US in the IT bubble crisis, 2000, 2001. And then there was a small video showing on CNBC each time an analyst, probably a quite newly recruited analyst, launched a buy rating on another technology name, which was extremely highly valued. Most of these stocks doesn't exist today. The video on CNBC was the penguin video when these analyses came forward, another buy rating on another highly valued tech stock. Of course, the situation today is somewhat different, but we have the same tendencies, haven't we? We have a lot of investors following each other without perhaps thinking too much of what they're actually investing into. It's a herd mentality that is forming. And of course, the AI hype, where you have built massive amounts of market cap before any revenue is actually realized in these companies, have last year propelled these names even higher, and the interest as it seems. On the small cap side, you've had cyclical pressures, you've had paralyzed M&A activity, and also you've had interest rates, which have, of course, penalized risk premiums in these small cap assets. And we have to also mention the buy side of perhaps these penguin-related mandates. You have the ESG mandates, who seem to think that you will make the world a better place by owning Apple or Meta platforms or stocks in this region. Actually, the evidence points to the contrary, doesn't it? These companies actually make our world a worse place to live in. So that's kind of interesting, I think. The passive and the semi-passive investment complex also, of course, is driving this very hard. And this is interesting since these AI models now, of course, are instructed to, worst case, buying AI-related stocks, creating a negative feedback loop, if you will. So that's what's going on in equity markets. This is why it's very important to think for yourself and dig deeper into what add value actually, where can you find value in these equity markets. So what is Scoggan doing differently? Why are we a different animal? And why is Scoggan focus different in these equity markets? How do we avoid getting caught into this penguin herd, basically? Well, we have a few different angles that we look for in equity markets. For instance, we look for forgotten or ignored equities, misunderstood equities, perceptions that are priced in but are not valid, they're not true, they're simply not true. We look for below-the-radar type of equities, where, of course, we have zero coverage in many of our names that we own in Scoggan Focus. We do our own analytical job to value these stocks. And this is the hunt for value. This is our contrarian path. We look for 50% upside in 2 to 3 years' time on normalized or steady-state earnings power, in combination with strong balance sheets, hidden assets, cross-holdings in Japan, real estate, and so on. This is the foundation for our hunt for value in these global equity markets. And it leads us, of course, away from these Magnificent Seven and into other type of names. We also want to highlight, on top of this, 3 themes that we think are underpinning global small and mid caps, why this is an interesting time to consider these complex in global equity markets. And the first theme is underappreciated domestic champions. We all know that the world is moving into deglobalization mode, where companies are bringing home local production, trade barriers are being set up. It's the agenda of the day and will remain so for the foreseeable future. That's not so good for the large caps that have this global dependence on their business. But domestically, you will have winners. And these are overrepresented in global small and mid-cap space. This is a very interesting area to dig into. Do we have any of these stocks in Scoggan Focus? Yes, we have. We have, for instance, a Philippine conglomerate, which you perhaps never heard of, but it's trading extremely cheaply, GT Capital, trading at more than 50% discount to its fair value, which is listed assets. And these mid-cap listed assets are also trading at a discount. So it's a discount on discount situation. We like this double discount. We look for triple discounts, of course, but double discounts will do too. We have First Horizon, a US regional bank. And of course, the entire regional banking space in the US came onto a great sail when the Silicon Valley banking crisis hit in the beginning of last year. That was the shortest banking crisis in recent memory, of course. It reduced the value of these equities. First Horizon being a great domestic winner. It's a bank with Southeast assets in the US, which is trading at extremely cheap levels. And it's definitely, and it's part of Scoggan Focus as well, at a 2% weighting. It's a domestic winner as well. And Japan Post Holdings, we also have. Japan Post Holdings is a conglomerate in Japan, holding a number of assets. We've been very active in Japan, in Scoggan Focus. We have about 20% weighting in Japan. The capital allocation policies among companies are improving. The corporate governance is improving vastly, which is something the general investor seemed to have missed. Japan Post Holdings holding a variety of assets in Japan, not only the postal system, but also banking assets, insurance assets, and so on. It's a huge domestic winner on Japanese growth. And it's the biggest position, actually, in Scoggan Focus, trading at about 30% of its book value around 5 or 6 times earnings embedded, which obviously is a very interesting value case for us in the fund. The other theme I want to highlight is consolidation potential. That may sound speculative, but when equities trade too cheaply, they will instantly become interest from strategic and industrial investors. And at Scoggan Focus, we experienced 3 of these consolidation events last year. When we had Textainer taken out at a 46% premium. That's a container leasing company that was trading extremely way below what we thought it was worth in the US. We had Vitesco, a powertrain producer, which was main holder Schaeffler decided to take out that company. Following a 40% right, we got another 20% premium on top. And then in Japan, we have, for you who haven't followed us so much, we had Pasona, which was a Japanese staffing company, which may have been one of the absolutely cheapest stocks on the globe, if not the cheapest compared to its asset value, and deciding to sell its sub, Benefit One, rallying the stock of Pasona by 70% only in November, giving our fund a nice boost, of course, into year-end. And you might ask yourself, do we have another assets in the fund which may be interesting from this point of view, on top of course, having that upside in our valuation models? Yes, we have. We have, for instance, Finia, which is a spin-off from BorgWarner. It's perhaps one of the cheapest stocks trading in the US. It's about 3 times its own cash flow. It's a fuel injection service provider and also an aftermarket player in this space. Spin-offs are very interesting because they come below the radar. Very little coverage on spin-offs. And also Finia being, we think it's a growth company. The revenues, their profits are growing. But the market prices is if it's going to be, not exist in 4 to 5 years, which is quite interesting. This is something, of course, that industrial and strategic interest would naturally take a look on. We also have Interfor, which is a lumber producer in Canada, which is trading way below its normalized earnings power. And it's definitely something that I think industrial interest should be interested in. And we have way over 50% upside in Interfor, this small cap trading in Canada. And lastly, I want to highlight Iveco, which is a truck producer in Italy. You might recognize it when you see their trucks rolling in the streets. This is probably one of the absolutely most interesting valuation cases in the fund currently. It is trading at only a half time EV/EBITDA, which is telling you something. It's only half times its own cash flow, the valuation on an industrial level, and should be of great interest for any investor interested in value, including strategic or industrial interests. It's a 3% position in Scoggan Focus. It's also a spin-off from C&H a couple of years back. And lastly, I want to highlight the next theme, and we touched upon it in the introduction. That is the neglected green transition winners. That's something that's also is overrepresented in the global small and mid-cap space. And of course, some people seem to think that you will make the world a better place by owning these tech stocks in the US. They're screened very well in these ESG databases and so on. But do they really have any green transition impact on the real economy? The answer is no, they have not. If you want a real transitionary impact, you need to hold assets from the old economy, the traditional economy, that have vast improvement potential in terms of carbon footprint and so on. That's what we're looking for, capturing that delta in the ESG, if you will, in the next 10 to 15 years. That's also powerful equity triggers. For instance, we have Cascades, which is a containerboard producer in Canada, which will be a pure play after they're spinning off their tissue business. It's a completely circular business, which is great. It should be an ESG star, should be priced as an ESG star, but it's not. It's not so well known for investors yet. We have Ivanhoe Mines, which of course has been a great stock for both Scoggan and Scoggan Focus over the years. You need copper to electrify the globe. This is one of the largest copper miners in the world, one of the greenest copper miners in the world, with assets in Congo specifically. It has been miners in general are very interesting from this green transition investing theme. And also lastly, we have Cementir, which might be the pioneer in green cement. Cement is desperately needed in society, we all know that. But they're going to be the first to launch green cement type of product They also have carbon capture facilities and so on, which they have invested heavily into. And this is also one of those names that will drive our carbon footprint improvement vastly over the next 10 years or so. And these are all, of course, trading at a huge discount to fair value. As we described, these are all holdings in SKAGEN Focus. So that was a few tidbits from the fund. So you know a little bit what we're investing into. Now, just a few words on our investment process in SKAGEN Focus. And there are basically three base pillars, if you really want to simplify things. It's cheapness, we described that. We need value. We don't invest in anything that trades at fair value. We need a very sharp discount, at least 50% in 2 to 3 years' time to normalize our steady state earnings power. And then we have change, because we don't want to get trapped into value traps. So we need change. We need catalyst for revaluation, at least 3 in 2 to 3 years' time. If nothing happens in 3 years, we're in a value trap. Then we'll sell it and go somewhere else. We're very disciplined to our price targets in this fund. We never hold anything above our fair value estimate of any stock. And then common sense, that is what SKAGEN is built upon, isn't it? Since the beginning of Christopher Stensrud and so on. This is how we price stock. This is how we scale stocks in relation to our price targets and so on. It's all firmly anchored into common sense. And of course, my team, we're not that huge of a team. It's just myself and David Harris currently. But we probably one of the longest standing contrarian value teams, global equity, small mid caps that you'll find out there. And currently we're running this fund in 2015. We have about 3.4 billion now NOK in assets. Also, of course, we have to mention Christoph Stensrud, who founded SKAGEN. He had his own version on these C's. We have 3 C's. He had 3 U's. It's the same content, the same basic principles of how you run money, how you find value, and how you should operate this kind of very active fund management structure. So, and just going into SKAGEN Focus again, a few highlights from the fund. We have 48 positions currently with a 34% weight in the top 10. It's 100% active share, so it's extremely active versus the All Country World Index, the MSCI All Country World Index. This is our benchmark. We also have a valuation in price earnings, which you'll see here, which is way below the MSCI equity, and should be so, of course. We're even way cheaper than any value index you might encounter out there. This is really reflecting the style trading at, we have a PE ratio of less than 10 times across in the fund. We also have the price book value, which is way below 1 in SKAGEN Focus. It's way below 2. It's way higher than 2 in the MSCI All Country World. Another sharp discount. Of course, this is what you expect from a fund like ours. And interesting, probably most importantly, we have a very solid upside to our price target, consistent with the gap we've been explaining today, this investment opportunity in small and mid caps, at around 70% to our weighted price target in the fund currently. That's a very elevated upside to price targets as we see in SKAGEN Focus currently. And then we're just going to show you a few numbers on our performance in SKAGEN Focus. Our official benchmark is MSCI All Country World. While this is measured versus the MSCI All Country Small Mid Cap Index, since that was what we referred to in the beginning, you'll see that we had a very nice return since what we call the big reset. That was the start of the pandemic. If you think about it, that was when everything turned. That was the start of a new investment environment. When rates started to normalize, bottlenecks showing up, a completely new picture from what you did see from the global financial crisis heading up to 2020. So during this period, SKAGEN Focus has done extremely well, not only versus the small mid cap, but also versus the benchmark of the fund and value indexes and so on, which we hopefully will continue to build upon during the next years to come. And lastly, this is the last slide, by the way. And this, we have described for you that there's a unique dislocation in global equity market. There's a unique discount between large and mega cap stocks versus small cap stocks, especially if you're willing to consider the Magnificent Seven to small cap value. for instance. But instead of minding this gap, we think, as you can see, you should mine this gap. You should extract it for value. Thank you very much. That was all I had for today.
Thank you so much, Jonas, for making that case for small and medium companies. And then, after all, last year was a huge year for the very biggest companies, as you also showed us. Why do you think this would change now?
Well, as we've described here, you have these, elevated multiples, of course, in these stocks that have very high weighting in these global indices and so on. And also you have these catalysts for global small and mid-cap to really re-rate through, for instance, rate cuts could be a huge catalyst for the cyclical areas for global small and mid-cap to really re-rate this year. And I think we have that ahead of us in terms of partially at least closing this gap that we have sort of described here today.
So if interest rates in the US in particular go down, that would favor the small ones, do you think?
Absolutely. It would first take down the risk premiums, which now are elevated. It would also propel M&A activity. And also, it would re-rate the more cyclically dependent equities in this area as well. Whereas in the large caps, multiples are already high, so it may be, the upside may be limited from here, best case.
Yeah. And there's one question. What do you see as the biggest risk coming up now for the small and medium caps?
That's probably if interest rates will stay extremely high, if inflation really starts to skyrocket, or at least rise more than anticipated. Everybody's obviously expecting a very sharp fall in inflation. If that weren't to materialize, there could be some setbacks during the way. But I have no doubt that this gap we're seeing is a historical opportunity, and it will at some point close, at least partially. So I think it's just a matter of time, basically.
And then a question from the audience here. Any specific sectors or industries that you find especially attractive from an investment standpoint now?
Well, we have our value focus, which means that we hunt for value in any sector, in any geography that have this upside that we really refers to. We've been quite active in small cap Japan, for instance, and we still find a lot of value in small cap Japan in a variety of industries. For instance, regional banks in Japan is trading at 25 or 30% of liquidation value, which is, of course, very low, since now, for the first time, these net interest margins might expand and so on, with rates going higher in Japan also. So that's one area we're following very closely, just to mention one example. We have 3 of such holdings in the fund currently.
And looking ahead now, what to you is the most interesting thing to watch, the most exciting question of 2024?
It's of course, the election in the US will be very important, how that plays out. It could derail or set things on track, depending on what's going to happen there. And also the pace of rate cuts. It is also, I think, really something that's going to dictate markets' behavior next year, and the dollar and so on.
Thank you so much, Jonas, for coming and giving us this great presentation. Big applause for Jonas Edholm.
Thank you.